The market cheers lower US inflation, but is that number credible? Headline consumer price inflation came in at 2.7% year-on-year in November, although that number is incomplete because data was only collected during the second half of the month once the government shutdown was over, exactly when Black Friday deals usually see retailers slash prices. That means traders are taking that release with a pinch of salt. They still only see roughly a 27% chance of a rate cut in January and just over even odds that one does come in March. Aoifinn Devitt is Senior Investment Advisor at Moneta. Aoifinn, how seriously should markets and policymakers take this inflation number?
Very interesting point you've made right there about the time period over which it was taken. We were expecting a 3.1% number. That 3% handle has definitely been where all inflation statistics have been heading. And we think that that is clearly not within the target zone, but that it was just about acceptable. It's basically low enough for the Fed to cut rates the first time. So we do have to take it with a pinch of salt. We still know that the tariff impact has not yet been fully felt, in that much of the tariff impact was delayed due to inventory hoarding and just some absorption of the damage by retailers who knew that consumers perhaps could not handle it.
Does that mean the market shouldn't expect a cut from the Fed at the next meeting and perhaps not the one after?
I have heard that the Fed will probably only do one cut next year. That has been what some commentators have been saying. That's far from what I think the expectation around a very lenient Fed chairman would suggest. There has been some expectation that we'd be off to the races for a 1% interest rate level. And that's quite different from having one bear cut next year. So somewhere in between is probably most likely. And what we'd expect is that the Fed will continue to be very data dependent. But the problem with a low read like this is that the next read could well be higher because, as you said, it is probably distorted.
Meanwhile, rates have moved higher this morning in Japan to a 30-year high, no less, and the yields on Japan's bonds have spiked. Should the market be concerned about higher rates weighing on Japan, given the size of its borrowing?
I'd say for Japan, the market is very focused on its trajectory, simply coming out of the slump that has been in for decades. There has been many false starts around the Japanese story. I think that used to be known as the widowmaker. There have been many investors that have, I think, depended on the expectation that there would be perhaps a greater focus on shareholder value, greater essentially rewards for the equity holder. So I'd say really Japan does not form a large part of most global investors' portfolios. It's interesting to look at as a case study as to what deflation could look like around the rest of the world. But I would say not many investors are going to be rising or falling based on the fortunes of Japan. It is an interesting academic case study, I'd say, though.
While elsewhere, the ECB sounded like its next move will be up on Thursday. Policymakers sounded more upbeat about the Eurozone economy. Do you agree?
That is certainly something that we would agree with. We have seen that the Eurozone economy having really beaten inflation convincingly, more so than any other economy, having had a very high conviction rate cut policy, it was really setting the stage for all the incentives to be in place for a boost. I'd say we have to manage expectations. We're not speaking about emerging market levels of growth. We're speaking about getting out of the anemic zone, the very low growth reality that has been the fact for most of the last few years in Europe. So will there be growth? Yes, green shoots we can see. We know that defense spending is very high. And we know that we're probably coming from rock bottom in terms of expectations for other sectors. But again, really manage expectations there. I don't see anything even approaching the US levels.
And the Bank of England struck a cautious note this week in a 5-4 vote, tighter than we expected. Does that mean we'll be worrying about stubborn inflation and weak growth going forward in the UK?
We've been worried about stagflation in the UK for many months and years now, I'd say. We did get some consolation from inflation coming to 3.2%, which at that time was close to the US level, which, as we said, we expected to be 3.1%. So having got down from those high threes and into the more manageable level, this was a bit of a break for the consumer, maybe suggesting that when it came to stagflation, we still had the stagnation in the UK, unfortunately, but not the inflation part. That was some reprieve. I do think that this interest rate cut will be very welcome across the UK, whereas we know many individuals have mortgages that are tied to these rates. They refinance often. So it's not like they had locked in low rates before. So this will come as a welcome reprieve as we run into a festive season.
That was Aoifinn Devitt of Moneta. Don't forget you can watch more videos on Reuters.com.